Welcome to Outlook Money's interview series Wealth Wizards, where you'll find money maestros in conversation with me, Nidhi Sinha, editor Outlook Money. In this series, I meet experts you've always wanted to listen to. Our guest today, who's known by many names, such as the Indiana Jones of the emerging markets, the Pied Piper of the emerging markets, and even the godfather of emerging markets. So you guessed it right, it's Mark Mobius, the veteran billionaire investor. His latest book, The Book of Wealth, meant for younger investors, is indeed a wealth of information as it contains the details of various investing instruments with real-life examples that showcase the pros and cons of investing in these. Mark is otherwise known to go out of his way to find undervalued stocks before others do. So from rubber plantations of Thailand to rocky roads of rural China, he's done it all. Till date, he has visited about 112 countries and invested in about 5,000 companies. Undoubtedly, we have a lot to learn from him. Welcome, Mr. Mobius, and thank you so much for joining us today for this interview.
It's a pleasure to be with you.
Starting with the question straight away, I mean, you are known, you've come to be known by many names, like, Pied Piper of emerging markets, no less than the godfather of emerging markets. And in fact, in a recent comic, I think they call you a bald eagle. So which one do you like, and how do you react when you listen to such names?
Well, I get very excited when I hear those names, and it's quite amusing. I particularly like the one called the Indiana Jones of emerging markets.
So going further, in your new book, which has just come out, The Book of Wealth, A Young Investor's Guide to Wealth and Happiness, you have basically tried to talk to the younger investors and address the younger investors and their needs. So could you talk a bit about the main messages that you really want to convey to them?
What I want to convey to the young people is it's not only about wealth, but it's about happiness. And this is, of course, it's all connected to health. It's very important for the young people to think about their health over the long term. When you're young, you feel very healthy, you don't have any problems with health. But as you get older, they must realize that if you don't take care of yourself, your life will be shortened. And the best way to get wealthy is to live longer because you have more time to get wealthy. The compounding effect is very, very important. The longer that you're able to stay invested, the richer you become. And more important than that, the longer that you live and the healthier you are, the more you can enjoy your wealth. So that was one of the things I wanted to put across to the young people, that health is wealth, and wealth does not lead to happiness automatically. You have to think about other factors.
In fact, you have a very interesting example in the book about this gentleman who had acquired a lot of wealth, but ended up committing suicide.
Exactly. That's a good example of where people can have a tremendous amount of wealth, but still they're not happy. And it's tragic in that way because they spend all their life trying to acquire wealth, but they forget about their own mentality, their own health, and their own relationships with other people.
Right. But one of the things that, kind of crossed my mind is that, the Gen Z and the younger millennials, they're not really the frugal types. You've, of course, talked about frugality, and we are, discussing now also that how wealth can get created in the long term. And if you're healthy and you live longer, then you can maybe enjoy the fruits of that. But a lot of people in this generation, they want, immediate kind of gains or returns. So how would you tackle that?
Well, one of the first things that people have to remember is that the Bill Gates of this world, the wealthy people of this world are one in millions. The chance of becoming very wealthy at a young age is very, very low. The probability is very low. So people have to remember that. You may get lucky and become wealthy when you're young, but it's very unlikely. It doesn't happen very often. So, so they've got to remember that in order to become wealthy, they've got to plan and think about how to do so, and more importantly, think about their own life. What do they really like? What do they enjoy? Because you can get very wealthy and then be very miserable at the end of the day. So these are the kinds of things I try to convey in the book. You know, not only the fact that you have to live longer, but also you've got to think about your happiness. What makes you happy? What's your objective? You know, some of the most successful people in the world say they have never worked a day in their life. What does that mean? It means, of course, they've been working. They may be an investment banker, or they may be a carpenter, or they may be a waiter in a restaurant, but they enjoy their work so much that it doesn't feel like work. Well, that's the kind of thing I like to convey to young people. Try to get yourself in that position.
Right. So that's a very interesting message, and younger people, they definitely need to heed to that. But I was reading your book further, and very interestingly, of course, it talks about the benefits of long-term investing and all of that. And in the section of equity, you've actually said that in the long term, stocks can be more stable than even bonds. In general, we generally, people in the financial domain or investors, they assume that the bonds or government securities or those kind of things are stabler. So what did you really mean by that?
Well, most important to remember that people think, oh, a bond is safe. No, a bond is not safe. Talk to the people who bought Argentine bonds, who ended up with nothing. And it's interesting, I have on the walls of my rooms here in Dubai the bonds of the Chinese Republic, which were never paid back, the Turkish Republic were never paid back, and you see the bond with the coupons, because people used to clip the coupon, and some of the coupons are missing, but most of them are still there. They were never paid. So that's an example where people think bonds are safe. No, bonds are not necessarily safe. They may be safe for the short term, but over the long term, they may not. But if you invest in companies with good balance sheets, strong finances, growing earnings, high return on capital, your chances of success are much, much better. And if you take the bond index, compare it to the stock index, the equity index, you'll find over the long term, equities outperform bonds by a wide margin. It's incredible to see the difference.
Right. So, and also, we've seen that, historically stock returns are, in a particular range in the long term. So that really perhaps makes them safer in the long term in that sense. So, so that was very interesting that I found in your book.
By the way, just following up on that, one of the things I try to convey in the book is that, yes, there's lots of fluctuations in the stock market, just like anything else. But it's very important for people to stay in even when things look bad, and reserve some cash always to go in when the stock market goes down, because that's the best time to buy. When everyone else is selling, you should be buying, because you will then gain the upside.
Right. It's very important for diversification. In fact, you've also talked about that, bonds are not so popular among retail investors yet. But the baby boomers who are moving towards retirement might see some kind of merit in it. So could you elaborate a bit on that? And especially, the retirement conundrum, because, the life expectancy is increasing worldwide, including India, of course.
Yes, of course. When you're young, you have a chance to take some more chances. You can maybe go into more volatile stocks or into investments which may be volatile. But as you get older, you have to be careful to ensure that you maintain your assets. And for that reason, some people do buy bonds. But I would say that you're better off with good dividend-paying stocks, companies that have strong balance sheets that pay dividends, because at the end of the day, that will probably be a better investment for your retirement. So I think it's very important to think in that way.
But in retirement, one of the worries is also regular cash flow, especially for people who do not get a government pension, etc. So they have to kind of, make it happen through their investments. What is the what solution would you provide them?
Well, I would say to them, first of all, keep about half of your assets in cash, earning interest in the bank.
Okay.
Then keep the rest, the other half, in equities, dividend-paying equities of strong, financially viable companies. Maybe a list of 20 companies that, so you have enough variety and diversification. That, I think, is a good formula for people in retirement.
Right. Coming to the markets, which, our listeners would be, really waiting to listen about. The third Modi government is already in power. The cabinet has been, taken its oath, but it still remains an alliance government. As in, there are, maybe it's unlikely, but there are certain people who might say that, it is dependent on certain alliances and other parties. So, and you have kind of predicted that Modi 3.0 means markets will kind of reach the 100,000 mark. So does your take remain the same still?
Yes, I think things will remain, because at the end of the day, I think even if you have a coalition government, the Modi policies for digitization of the economy, for advanced technology will continue. The great thing about India is that you have this variety of states who are relatively independent and can do things on their own. And many of them are now competing to develop technology because they've seen the benefits of doing that. So I think, regardless of who's in power in Delhi, I think the progress will still be there in various states, and you see the country grow very rapidly.
So you are saying even if the government doesn't continue, there is the Indian economy is robust and will take it for, the markets will see good returns in the long term?
Exactly. You're seeing incredible growth. The young population, education is growing at a rapid pace because of the internet, and people are moving into the cities. More urbanization is growing very rapidly. One of the problems, of course, is infrastructure. The government will have to continue, maybe even accelerate infrastructure development, whether it be railroads, whether it be bridges, highways, and most particularly power. India needs more and more power as people become more wealthy. So this is something that we have to really account for.
Also, another thing that I would like to ask is that besides local factors, given the macroeconomic conditions, where is the Indian market going?
I think the Indian market is going on only one place, and that's up.
Okay.
I say that with some reservations because you're always going to have corrections along the way. In a bull market, you will have corrections, which will be opportunity for you to buy stocks, more stocks. But I would say the Indian market is on a roll and will continue that way going forward.
Okay. So in fact, you were talking about globally markets going only up. That is the only direction that they go. But you've also called India the safe haven for investors. And what makes you say that? And do you think it will remain so?
Well, I was referring mainly to the international investors who are investing in emerging countries. Now, it doesn't mean they should put everything into India. All I'm saying is that India should be a very important part of anyone's portfolio. Because of the growth that you see in the country. Of course, you've got to look at other countries. You've got to look at China, you've got to look at Brazil, and these other emerging countries, as well as the US market, of course. But India should be definitely a part of any investor's portfolio.
Right. You've been to India, like you came to India earlier this year. So what are your main takeaways from India as such, in terms of culture, your experiences?
Well, I mean, first of all, of course, culture, the incredible variety of culture, the richness of the culture is amazing. It's just incredible as you travel through the country. I wish I could have spent more time in each place, but it was just amazing experience for me. And that's one thing. The other thing is the vitality of the people, the activity and the enterprise of people is so good. And of course, I'm a big fan of Bollywood. So
Okay.
I had to go to Hyderabad to visit the Bahubali.
Okay.
Where Bahubali was filmed in that amusement park there, Ramadi Park.
Yeah.
So, I mean, I think for me, it's an incredible experience, and it also tells you something about the country because this incredible richness of the society and the culture adds a lot to the enterprise of the people and the ability for them to create new things. So it's really very, very, very nice.
So interesting to hear that from Indiana Jones to Bahubali, the Hollywood, Bollywood, those kind of figures really fascinate you. But you've also been known to kind of, go to different places. You've been to about, I think, 112 countries till now. And your website, in fact, says that from the rubber plantations of Thailand to the rocky, pothole-ridden roads of rural China and whatnot. So, you've been to India now. So are there any undervalued stocks that are really on your radar from the India market?
Oh, there are quite a few. I mean, we always look at the return on capital, on the debt, and make sure we get companies with very little debt and with earnings growth. And, we do global scans. We look at all the thousands of companies around the world, and India comes out a lot. A lot of Indian companies pop up in that scan. So it's pretty quite exciting.
Absolutely, absolutely.
So I would say this, it would be a good idea for people to look at the railroad related stocks, to look at the power companies, and to look at, one of the amazing things about Indian companies is that many of them are global in nature. Indians have been very good at going globally, mainly because so many of them speak English, and they're very open to go globally, to open up offices and to sell globally. And companies like that in India would be a good bet to look at.
Coming to the end of this conversation, Mr. Mobius, what are the 3 big money mantras that you will really give out to our viewers, especially the younger viewers, in terms of investing in the stock markets?
Number one, I like to say emotion is the potion. In other words, pay very close attention to your own emotions and the emotions of others, because that's what drives the market, the emotion. And be careful to control your emotion and observe how other people are not controlling their emotions. Because when people are selling, that's when you should be buying. That's number one. The second thing is that be patient. Don't be in a rush. Don't think that you can become wealthy overnight. Yes, there are maybe a few, 1 out of a million people that will become rich overnight, but don't think about that. Think about your own ability to get rich over the longer term. So you have to be patient. Number 3, don't listen to anybody's advice. Listen to your own advice after your own study. So don't listen to Mark Mobius. Don't listen to any other guru who may suggest something. Listen to your own heart and make investments accordingly.
The last one is pretty interesting because, what happened recently, everybody saw that, certain politicians said that, election day is the day to make money in the markets, and the markets, kind of crashed like really bad. And I'm sure a lot of people were bitten by that. So thank you so much, Mr. Mobius, for this short and very informative chat. And thanks a lot for, it's a pleasure having you here.
It's a pleasure. Thank you very much. All the best.
All the best. Thank you.